You're about to join Niels Kostrup Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Katy Kaminski and I, Niels Kostrup Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Katy, it is wonderful to have you back on the show. How are you doing? How are things where you are today?
Things are good. You know, it's fall starting up. You can feel it in the air here in Massachusetts. A little bit chilly. Starting to feel like school starting, which is good for me. Yeah.
It's funny you say that. This year is only our second year where our kids are not starting school because they're in university now. So it doesn't feel quite the same. But I remember fondly the difference between having them home all summer and then suddenly school starts and everything quiets down. So I feel you on this one.
It's a nice time of year.
Exactly. Now, Katy, we obviously have some topics that we want to talk about, and I think people will be very. It'll be enlightening to see what you've been up to. But I always like to ask, sort of, in terms of other things that has been on your radar, things you've been sort of monitoring, slightly or kept sort of an eye on. Is there anything going on in where you are in the US economy or in the world, around the world? It's not that there's nothing going on in the world right now. So anything you've been keeping an eye on?
Niels, this year has been so hard to figure out what's going on. I think that's the general theme for me. It's just there's different stuff going on in different places. And we had such an extreme event last year that people just haven't really, it's like sorting out the tea leaves. Nobody's sorted them out yet. And that's how it feels. And I think people really, I don't know. And I think I'm excited to talk to you today because I think maybe you'll have some insights too. It's a hard one, right? It's been a very particular year this year, like a tightrope, kind of.
Exactly. And actually, I think it's quite interesting what you say even then. And that is, I think we often struggle a bit when asked. I guess a lot of people look at you for answers. Maybe they look at me for answers. And the thing is, this answer where we say we just don't know. It's something that is quite hard, and people might sometimes get a little bit disappointed when you say so. But I think you're absolutely right in describing that this year is just all over the place.
Yeah, everyone was convinced in the beginning of the year that the recession was coming, and now nobody's convinced it's coming. And now everybody's convinced that we'll have rate cuts, which I disagree with. We can talk about later. And I think everybody's ready for everything to go back to normal, and that's not happening. And everyone was excited that China was going to reopen, everything's going to be great, and that hasn't happened. And I think we're just kind of stepping back and going, where are we? And we're standing on this tightrope. Do we step right? Do we step left? Do we fall? If we do we fall in a pit of fire, or do we fall into a feather bed? So it does really feel like that kind of situation where we're not sure which way we're going, and are we going to step in the wrong direction? It felt that way all year this year.
Absolutely. Well, lots of things to talk about, no doubt, in our conversation. Before we dive into all of that good stuff, let me just sort of quickly, because we are recording on September 1st, so we just finished the month of August. Actually, it was it was a little bit of I think overall a little bit of a down month for the industry, although there's going to be some dispersion in returns. But I would consider it as a pretty uneventful August, at least compared to some of the Augusts that I've experienced in my career, with some crazy stuff going on. So I think we can sort of have a sigh of relief saying, well, nothing too crazy went on in August, at least. From a performance point of view, probably what decided if people finished in the black or in the red is most likely a little bit of trend speed, I would imagine, especially in stocks and bonds where we saw, most of the losses, is from what I can see. And also, of course, this is a month where for those managers, and this is probably not the big managers, I would imagine, but a lot of other managers that have exposure to smaller markets like orange juice, they might have had a slightly different experience in August than most of the big managers have, just because, again, talk about a crazy trend going on there, which is quite fun. Other than that, I would say commodities generally did okay for trend followers in August. And that's probably where some of the, or most of the profits came from. My own trend barometer finished at 30, so that's still suggesting kind of a downward drift to performance for trend followers. So that's so far, at least from what I see, in line with the indices. The indices as of August 30th, so 1 day before month end, down 0.5% for Beta 50, down 1% for the month. For the year. SocGen CTA down 0.25% for the month, down 1.3% for the year. SocGen Trend Index down 62 basis points for the month and down 2% for the year. And the Short-Term Traders Index down 48 basis points for the month and down 3.5% for the year. Equities, of course, also struggled in August, down 2.55% for the MSCI World, but still up 14.75% for the year. And the world government bonds down 0.25% roughly, and the S&P 500 down about 1.77% and still up 17% or so for the year. All right, Katy, with all the admin stuff out of the way, now it's time to dive into some interesting topics. The first one I wanted to ask you a little bit about, and of course some of what we're going to talk about today is based on some of the amazing research that you and your colleagues write about. So we should, of course, encourage people to read all of the papers that we're talking about today. We're not gonna read them for them today. We're going to talk about some of the bullet points from these papers. But the first one I think is very interesting because for many, many years, I think a lot of critics of trend followers probably said, well, trend followers for the most part have made all their money in the last 20 plus years just being long bonds. And it's true. I mean, we made a lot of money from being long bonds. So I wanted to ask you a little bit about this topic because you've been writing about, well, maybe from the fact that markets did move generally in one direction in the bond markets, could certain biases have crept into the way we design our systems, et cetera, et cetera. So why don't you talk a little bit about these things and the challenges?
Oh, I love this topic. We wrote this paper. It's called Beyond Bond Bias, Perspectives of a Systematic Trader. And the reason this came about is that we work with a lot of institutions and we're very pure trend. And so a lot of institutions started coming to us and saying, not all the trend followers are taking, reasonable shorts in fixed income this year during 2022. And, when we sort of started to look across the board at the positions and estimate them, we started to see that, not all trend following systems were willing to necessarily take shorts in fixed income after we had spent decades kind of defending the exact argument that you just said, Niels. And so we started to ask the question like, oh my gosh, it's really quite reasonable that you can build in a long bond bias in your system just in multiple different ways because it's always better to be long bonds throughout most of history as a trend follower. And it's actually pretty much good to be long bonds in most scenarios for the last 40 years for anybody. And so what's fascinating to me, and I have this conversation with all sorts of investors, is that so few people have this concept. When you say short bonds, they say short duration. I say, I'm short bonds, and they look at me and they say short duration. And the reason is they've never thought about it. And then I actually had someone in the media, say to me recently, I said, I'm short bonds, and they say short duration. They said, how do you do that? They didn't know how. And the reason is because it hasn't worked. And so we decided to try and think about, let's try and examine this concept from the concept of somebody who's not supposed to be biased. A systematic trader is supposed to measure opportunities and size positions as a function of their opportunity set. And so if you bias your system to reduce exposure to things that are, that you don't like or that haven't worked in the past, then when the world changes, you can tie your hands. And so that's kind of something that was fascinating to me last year because when we looked at the data, it was possible that some people might have tied their hands. And so when we did this particular paper, we started off by doing some empirical studies. and looking at the bond betas for different funds. And we did see a large variation in terms of beta exposure to short fixed income across many different funds. And last year, the biggest differentiator in performance, hands down, is how large was your bond short. And ironically, the bond short was in notional terms not that much larger than any sort of long bond notional that you'd ever see. So it's not like this was an outsized position or outsized beta. It was just a normal short beta that you would see in any asset class, like, commodities or dollar. And so to me, that was fascinating because it is like in our psychology that if something hasn't worked in the past, we don't want to do it. And last year was a perfect example where something that has never worked really well. And so that to me was just such an interesting thought experiment for me to think about is, how do you build a bias into your system?
Yeah. And when you looked at these different managers, were there certain clues that sort of came out of it saying, well, this is probably most likely for why it's occurred? I mean, is it time frame? Is it other things? Or is it just the data they choose to look at that ends up creating this perhaps unintentional bias?
So I would have loved to call them all up and ask them that question, to be honest with you, Niels, but I didn't have the inside to the inside box. So instead, what we did was we said, okay, so we do see some differences. And then we stepped back and we said, okay, so we see some differences. Let's do a thought experiment. What are some of the ways that bias creeps into your system, both intentionally and unintentionally? And so we started in the paper, we divided that up, and we actually looked at how these different approaches might actually leak into reducing your bond beta. So one of them would be you could include, some constraints, for example. So you kind of subtly add some constraints on your system, which kind of say, well, we'll just kind of shrink the position or cut the position when it gets big on the downside, because we don't like that, right? Another is that you can add other strategies or other things that might actually have that long bond bias, things like carry or other things as well into your system. And then finally, which was really fun in this paper, is we looked at machine learning. So you can look at data from the past and you can learn, oh, this is how I should respond to trends. And if you use data in the past, which particularly we tend to use data that's available from the last 40 years, you can learn how to respond to trends and how fast and how slow. And that will tell you how to trade those trends going forward. And that particular approach will also include a bias more unintentionally, but data-driven. And we found using these approaches, we could explain that both constraints might explain it, but you could also have data or the way that you sort of design your system, even using machine learning, could easily learn a bias that might cause you to be reticent to actually take a short position, even though a very simple trend model like your moving average would be screaming, short the bond. Your machine learning model might say, watch out, don't do that. Or your constraint would say, don't go there. And so I think that was very fascinating, is that we couldn't actually ask managers that question. So we asked ourselves the question, if we're building a system, how could you build in this bias into your system?
It's funny when I hear you say that, Katy. I mean, of course, you're absolutely right. And we've come across this in certainly in one other sector, and that's equities, when people are, certainly investors would say, well, I'm long equities generally speaking, so I don't really need trend follow to be long equities. And then some managers have actually then responded at saying, well, we have all these building blocks. You can take the equities out from the long side or whatever it is. But interestingly enough, I've actually never really come across that discussion when it comes to bonds. Nobody has ever called me up saying, I don't like you being long bonds. Have you, is this something you've come across?
No, because bonds always worked. The reason they say that is that bonds are, I love you asked this question, because in another paper that we're going to talk about later, like you wanted to ask about, the frequency on bonds is just different, right? So most of us have not been working in the financial markets during a period like the 70s or another period in history where bonds were upsetting. And I think the other challenge with bonds, and this is something that puzzles me to this day, is that bonds have fixed cash flows. So people always perceive them as unrisky. And there's this concept too, and I've been scratching my head about this all the time recently, because we can talk about this more later because it's so fascinating, is that this idea that, you can get 5% for a 2-year and you can get a 4% for a 10-year. To me, it's confusing. And when you ask people that, like, why would you buy that? It's fixed. And something about the fixed nature and the yield of those assets, it naturally lends itself on a longer time horizon to make sense. But it's something about that fixed nature and the fact that it already has a yield that people don't think about NPV effects. So when yields go up and you owned a fixed cash flow, guess what? You lost money. But as long as you don't talk to your neighbor and realize you have a worse mortgage, you don't care. And that's kind of like an intrinsic bias that people have that is there in fixed income that we haven't thought about because we've been in a falling rate regime for 40 years. And I think people don't think about it. It's interesting.
Yeah. It's fascinating. One other thing that I think a lot of investors may not know is, of course, and this doesn't necessarily have a huge impact. You would know this much better than I do, but people may not realize that actually futures markets, which is what we predominantly as an industry are focused on, they were really commodity only up until the 70s, early 80s. And of course, since the early 80s, we've had falling interest rates. So all the data we can get on futures for fixed income is kind of in more or less one direction. Now, I'm not saying that necessarily influences a lot, but I'm curious, and you may not know the answer. It's a little bit unfair for me to ask it perhaps, but if you're a manager that generally wants to trade universal parameters or treat all markets equal rather than having specific parameters for certain sectors, etc., I think it's fair to say that most of the big managers have probably more bond markets in the portfolio than any other sector. Maybe currency. Some people have a lot of currency. I don't know. But how much does that actually influence if you want to trade universal parameters? Does it kind of tilt a little bit towards, it will end up picking, we're going to end up, I say picking, but that's not what I meant. But we end up having parameters that tend to work quite well for what we've seen in bonds for the past 40 years, yet still, works okay for other sectors.
Well, you're asking a question that's actually universal for all hedge funds. I think that's an issue. And I got this question the other day because someone said to me, yields are higher, so your funding rate is higher. And I said, well, that's not how futures work. Actually, it's good for us because we're going to get carry on our collateral and we can short bonds. So we're actually shorting bonds right now and earning collateral. And he was like, what? It's kind of funny. But no, it is true that I think everybody right now has to go back to the drawing board and ask themselves the question, how much are your strategies that you've developed dependent on a falling rate regime? Because if we move to a new regime, it could be the case that a lot of strategies and approaches, whether it's value, whether it's anything that you're using in your portfolio, if it's dependent on a more of a falling rate regime, you can have a very different result. And I think that's where this long bond bias is so fascinating, is that we're so used to this particular regime, and the only people who, you go to the dinner table and you talk to your parents or something and they complain about mortgage rates in 1978, and you kind of listen to them and go, okay. But the truth is that there were different regimes, and I'm not saying this is the 70s, but if we are in a higher rate environment and we do actually have higher rates for a longer period of time, and we're no longer in a falling rate environment, some strategies don't work as well in the same environment.
There's one thing you said also early in our conversation that I thought was quite interesting when we talked about that this year feels a little bit strange. And that is this thing about that people expect things to go back to normal. And they've defined normal as pretty much zero interest rates and 2% inflation and all of that stuff. But of course, well, I certainly couldn't say it about you, Katie, but for myself, who's been around long enough to know that that is not normal, and again, maybe based on some of the conversations you have with people, but when we interview people on some of the other series in this on the podcast, they don't necessarily expect us to go back to quote unquote the way it was for the first 2 decades of this century, and I kind of share that. In particular, I share also what we recently discussed with Neil Howe about the fourth turning and how these periods tend to be very disorderly, that they're all often associated with high inflation, high interest rates, et cetera, et cetera. Now, as systematic investors, we don't make any forecast whether that's true or not, but we do look at historical data, and we tend to think that markets, I wouldn't say repeat themselves, but it certainly rhymes with what we've seen before. So I'm not sure where I'm going with this as a question, but I am puzzled about this thing. People expect things to just go back to the way they were, and I'm not sure they will. And where does that leave investors really, so to speak?
Yeah, that's the conundrum for me too. I think sometimes, and maybe this is me having my own bias because I used to be an MBA teacher, and I remember when we had negative energy prices in one year, and then we also had negative interest rates, and I was teaching a class and I was like, think about that. And I just stopped and I was like, think about that. And then the students looked at me and they were like, what do you mean? And then they came back and said, I don't understand. And then I said, well, neither do I. So what I'm saying right now is what's puzzling me is we're in this world right now where short-term rates are high, longer-term rates are low, inflation is high, and the whole world is expecting that we're going to go back down to zero, which means they're expecting rates to get cut and everything to go back to where it was. Whereas the MBA teacher in me is saying where's the term? We need a term premium. And if there's stress and risk in the world, there's inflation, then we need to have a yield curve that looks logical, and people need to be paid to hold risk over longer horizons. And if we have all this dislocation and supply chain issues and waves of cycles of valuations of commodity prices, then we're kind of more back in a normal economic cycle, which doesn't necessarily mean a disruptive cycle, just a more, normal economy than when I'm sitting there going, okay, so what does it mean when you have a negative oil price? Right? It's more like a normal supply demand mismatch sometimes. And so to me, I think that's where we're trying to go, at least in my head. We're trying to go to a normal economic scenario where, you have economies that are disjointed. Sometimes China is trying to figure out how to get back going, and the US is figuring out if they've slowed too much or not. And, you have some inflation and some, that to me, I know that it's upsetting when you're used to zero interest rates, sounds pretty much like a textbook economic scenario. So if that's the case, I feel like it'd be better if people tried to think about that as the new normal instead of trying to see how we can get back to where we were.
It reminds me of one of the things that I think, you've been first a couple of times talking about certain concepts, and I think certainly for me, you must have been one of the first ones who kind of had a really nice way of visualizing convergent versus divergent strategies. And I think, in a sense, what you're painting a picture of here is just to say, well, actually, for the most part, markets are divergent. But we've had this convergent period of extreme carry where central banks were in control, economies were synchronized for about 20 years. Inflation was not a problem, so we could keep interest rates, to the floor. But that's just not how the world normally operates. And now we're slowly, or maybe we are fast moving towards a world that is more normal, but that normal world is divergent in nature. And this also is why I think you and I sit back and we look at this year and we're thinking, we have no real sense of a theme. There's been so many things going on at the same time. And of course, and sorry for this to be such long-winded, but people have in the past often talked about trend following as being a long volatility strategy. But you always came out saying, well, it's actually long divergence. And so can you talk a little bit about that? Because I think it's a good refresher for people at this point in time.
Yeah, and I'm glad you bring that up because we haven't talked about convergence and divergence in a while. And this is a great new paper. No, just kidding. Now I got to come back and write another paper. I think convergent strategies are really looking for things to kind of converge back to something, whereas divergent strategies are following things that are breaking out. And in a world where things are changing and breaking out, it definitely feels like that was last year. And this year feels a little bit of both, right? And I think as somebody who trades a divergent strategy, it's really sort of this type of environment it's more interesting, a divergent world, right? So a world where all monetary policy is converging actually is not great for the active trader because everything is kind of converging to the same thing. And it's more about the long-term investor, and it's about buy and hold, and it's about risk premia. But I guess you're right. That's not really, hasn't been sustainable over centuries. If you think about it from a long-term perspective, it's not necessarily the best strategy over centuries. It's worked really well for a short period of time. So I do think that that's a concept to reconsider and think about again. I'm going to go back to the drawing board on that. You just gave me a good idea for a new paper. Thanks, Niels.
My pleasure. Speaking about new papers, I do want to talk about another paper that you wrote. And we can always come back. I mean, we're going to mix and match this conversation because there's just always so many great things to talk about when we get together. And but you did write another one that caught my attention, certainly, because it is another thing that is really very close to your heart, but also what you're known for. And it's the word crisis, but then again, you raised the question, well, is it a crisis? Is it a correction? And all the challenges that comes with that simple question. So I'd love to spend some time on this, and maybe you can talk about some of the things you found and you wrote about.
Yeah, so let me tell you, the name of the paper is Crisis or Correction, Managing Expectations for Managed Futures. I think that's the end. That's long enough. The funny part is this paper was published in 2018. And if you remember 2018, we had the vol apocalypse, and then I think it was February 5th, and then we had a really tough day on October 16th, which were these really sharp V-shaped recoveries. And many of the clients that we worked with started coming to us and saying, like, the market's down, you didn't make money. What happened? And it was really hard because they loved the term crisis alpha. Let's just be honest. It was something they loved. And so we said, this is a correction. It's not a crisis. Let me explain. And so we wrote this paper, and it's called Crisis or Correction. And we wanted to really differentiate the difference between a crisis and a correction to help our clients understand expectations for the strategy in these type of environments. So a crisis is a sustained period of losses which does not recover quickly. A correction is a period of losses which recovers quickly. And so the key difference there is if you think of something like the vol apocalypse, yes, it was terrible, but it was gone within a week or two. The same thing in October of 2018. It came and it went. When you look at more severe drawdown periods, those are more of a crisis than a correction. And so what we did in this new paper, and what was really fun about it, is we started getting a lot of questions last year. Are we in a crisis or are we in a correction? What's happening? Where are we in the cycle? And another really interesting thing came out, and we just talked about bonds. Are we in a bond crisis? And it was the first time I heard that ever in many years, right? And so this time we actually updated the paper and examined crisis periods for both fixed income and equities, and examined managed futures performance during crisis and correction periods, as well as recovery periods of crisis, to understand expectations of what typically happens for the strategy during these. And so if you look at the results from the paper, it's very interesting. And we have some nice bubble charts. I love bubble charts with color, and red and green. So you can see like good good periods and challenging periods. And what you see there is managed futures really likes a crisis. Managed futures can struggle in a correction, whether it's fixed income or equity. And this makes total sense because a correction is when the world is standing somewhere and it moves quickly in the other direction and then it moves back. And when you're a systematic trader, you're following where the market's moving. And if it moves quickly against you, you don't have time to go with it. You don't have time to pivot. Whereas a crisis happens, unfolds, and you have to move with that crisis. And you have to find those opportunities in the wake of something very volatile. Corrections, unfortunately, they're sort of like pops of volatility. And this is why we're not necessarily long volatility. It's basically pops of volatility that sort of shudder against your signals and then go back to where you were. And that's never good for a system about detecting direction. And so this paper was really helpful because it helps to give a nomenclature of when you're in a correction, it's not necessarily clear. It depends on where we're standing in that correction. If we're standing in the right position, we might do well in a correction. If we're on the other side, not necessarily. And then if it's a crisis, we have the time to actually pivot to try and capture what sort of happens in the wake of a crisis to potentially capture that crisis alpha that we're trying to capture in market trends.
What makes these things even more confusing, Katy, is that what may for some feels like a crisis, it doesn't actually show up in the data as a crisis, meaning it can be very orderly, yet it can be very painful. And the way I would visualize that is, of course, is also just how sort of the appetite for long vol strategies goes in and out, because they tend to come back in flavor after like a situation like COVID. And then you have a year like last year where actually stocks were also down, a decent amount, and yet long vol strategies didn't do so well. I have a couple of questions about these things that I'm personally curious about whether you found anything about this. First of all, I've noticed, and this could be like the famous last words, right? Where you say, I've noticed that crises, quote unquote, corrections are becoming shorter and shorter in time. And then as soon as you say that, you have a major long-term crisis ahead of you. But since we don't know what's ahead of us, I have noticed that there are more corrections than there are crises, it seems like. Do you think that has anything to do with just the kind of how the world is, I wouldn't say operates, but I think you know what I mean. I mean, why are we seeing shorter and shorter crises compared to, 20 years ago?
So I might actually disagree with you a little bit.
Oh,
which is
by
good.
all means. Yeah, that's great.
I felt that way in COVID. I really did, because that was so fast and it moved so fast back. But if you look at the data, because I'm such a data person, that if you look at the data in this paper, that's what's kind of fun, is there's not a lot of like major crisis events. There's only a couple really big ones, right? Last year was pretty bad and pretty long. So it was pretty long and pretty bad for equities and pretty long and pretty bad for fixed income. And so it was a very long, that's what amazed me. Like, let me give you the example. Last year, at the beginning of the year, I asked all the people in the room in an audience, probably 100 times last year, do you think rates are going up? And everyone said yes. And I said, what are you doing about it? And they said, nothing. And I said, anyone here short bonds? And they'd say, no. So that's what, that trend was so long and nobody, and the Fed came out every day and said, we're going to fight inflation, pay attention. And it was so slow. So I agree with you. There has been some really fast ones, I think, in equities, right? But some of them have been pretty slow. And actually that trend in commodities that we saw, and that's not a crisis trend, but the trend we saw in commodities related to inflation, that was also super slow. And that's kind of related to like the stress of inflation. I think the energy trend the long energy trend started in the spring of 20 and stayed until the spring of 2022. So it was a 2-year long trend that was relatively positive. So I do agree that I think especially equities, I think that might be true. And this could be the case in equities because people are paying attention. People are, actively involved. There's retail trading. There's all this stuff. So what do you think about the hypothesis that could be true for equity markets, but for some of the other markets, people are just not as actively involved? So like commodities or, fixed income. So I still think there's definitely trades that are slower. Just equities definitely do feel faster and more corrective and hard to trade. But they've always been hard, I think, too.
Oh, yeah. For sure, I think from a trend following perspective, it's a very difficult sector, even though, and this is what so is the word disconcerting for me, that is that so many people, well, you see a lot of advertising for, you can become the next best, the next trend follower, you just buy this course, and it only talks about you trade equities, but actually equities is not necessarily the place you want to be a trend follower, and people don't understand the importance of diversification, which is another whole conversation, maybe for another time. But you're right. I was referring mainly to equities. You're also right that last year was long. But I think this is what I referred to earlier, saying it didn't feel so much as a crisis, but you're absolutely right. You could say it was a crisis in many respects, and a lot of people, institutional investors, lost a lot of money in these situations. So maybe we need to come up with another name than crisis alpha, because we need to include the correction as well. I don't know. It's a challenge, Katy, for you.
Yeah, it's hard. I mean, I think for me, I think about the way that I define a crisis is how much return is your client losing? And right, it's like if they lose above a big enough amount, then that's a serious issue. And I think what was particularly hard with fixed income is I think a lot of people, like I said, they have a money market fund or something, and they just don't think about that it can lose money because they think, well, it has a yield, so it can't lose money. But I'm like, NPV, and so I think that's what was hard last year is I've talked to a lot of retail investors that say that to me too. I mean, their financial advisors put them in these funds, and I said, when rates are going up, you don't want to buy bonds, and I think that's where it just always has been easy to do that. Just do it and you'll be fine. And last year showed that that's not the case always. And I think that's hard to kind of conceptualize for a lot of investors who are used to that.
Yeah. Before we move on to the third part of our conversation, which is more kind of maybe market related and stuff that's going on right now, given what we've talked about so far, I am curious because, again, you speak maybe to a lot more financial advisors than I do. And I'm always fascinated about how to position, in lack of a better word, or how to visualize for people how they should use trend following in a portfolio. Of course, I come from the school of thought that you should, have it as a core allocation. It should stay there forever, et cetera, et cetera. I'm also facing a lot of resistance in that thought because people like to time things and maybe they don't necessarily agree, et cetera, et cetera. Do you think that part of the conversation, do you think that's changed or, based on what happened last year and maybe earlier this year as well, is there a different narrative or is there a different understanding of the role of trend following in a wider portfolio among the people you come across?
I hope so. I mean, I think it's hard because, anything new or different is always, there's a learning curve, right? And I do think that, part of what our goal is to help people understand what they're investing in so that they know when it works and when it doesn't work. But I think the key thing is really making sure that people add different things. So diversification. I mean, we all talk about this so much, but I really do, that since I started in the industry, there has been at least a lot of progress in the sense that people have learned about these things. They're starting to understand that it's important maybe to have exposure to other asset classes, that it's important to have exposure to alternatives, to things that might work in a different year. And a year like last year helps us, right? I mean, it just helps us. Of course, it doesn't help us when somebody expects last year to repeat itself. But it does help us to realize that there are proof points. There are environments where the 60-40 isn't there. And that gets people to go back to the drawing board and say, oh, geez, I need something else. Or, oh, bonds were my best friend for 20 years. What do I put in here instead of bonds? Like, I always loved bonds. They were my tried and true investment. And they probably will be again soon if we could get a stable yield curve. So no offense, I'm not dissing bonds. I'm a short-term trader. They'll probably be fine in a year. But, but it really goes back to the drawing board and says, hey, maybe we need some different things in here. At least that's what we are hearing from people, that they're open-minded to kind of think about things, which is good.
Yeah, which also actually kind of leads me to ask you this question, somewhat related, and that is, for the longest time, at least, I remember talking to people about, well, trend following is and inspired by your writing and your wording about diversifying it during crises, but we were always relating that to equity crisis, right? That was always kind of the understood crisis we were trying to diversify away from. But you raise a good point. I mean, last year was a wake-up call for many investors that actually a crisis doesn't have to be in equities anymore. So do you think, does that make it easier or harder for us? Because now there could be two different types of crises that people should diversify away from.
Ooh, that's a good question. I think it's both easier and harder. It's an easier word for us from a divergence center in that the world is more chaotic right now. There's a lot more stuff going on. So it's an interesting time to be a trend follower and to be trading actively, I think, now, because there's just a lot of, in any type of more chaotic society and environment, there's more opportunity, there's more turbulence. But the challenge is, for the traditional investor, the simple solution doesn't work as well. And I think that's hard. So this simple, just buy your stocks and your bonds and you're fine. If that doesn't work, it is hard, right? Because it means kind of explaining, well, if this happens and this might happen, and then it becomes a bunch of combinatorics, and that's hard. I personally have always had that view. Everyone comes to me and says, crisis solves as equities. I actually wrote a paper a couple of years ago in P&I, which was called Crisis Alpha Everywhere. So, and I loved it because the idea was exactly what you asked me. And it was this idea that crisis is really about sort of something disruptive, whatever it is, whether, and the reason I think, let me give you a good story for this, is that I remember I think it was in the Middle East on a trip at one point in I can't even remember the year, a couple of years ago, maybe 2016. And I was there and oil prices had been down and people were just so upset. And it was just such a different thing because it felt like a crisis there. Whereas the US, the equity market was up, so everyone was fine. And the truth is the crisis, or a crisis, is in the eye of the beholder, right? It depends on what you do. So if you're, dealing with oil prices, then that's your crisis. If you are exposed to fixed income, then that's your crisis. So the truth is what's interesting to us is we like things that move a lot, whatever it is. And any crisis is really a moment where there are trends. And so hence we like crisis, whatever type of crisis it is. Some crises are not disruptive to everybody and others are. And I think the bond crisis is a perfect example of that. People kind of ignored it and pretended it would go away and tried to not pay attention to it. Whereas an equity crisis, what do? They go and they look in their, Ameritrade account or their other account or some other account that they have, and they go, oh my gosh, my 401k is down. This is terrible. And they didn't think about probably their bond fund or sort of what that meant as much. And that's where it's all about, how people think about it and whose perspective it is. Somebody who owned all bonds probably might have felt pretty bad about it, right? So I agree. It gets complicated. That's why I said complexity. Yeah.
Yeah. No, it does get complicated. And actually, I think that your last sort of sentence about people who may have been more exposed to fixed income, which I think of as being Europeans in particular, and European pension funds specifically. Maybe for the longest time, they didn't really pay a lot of attention to what we were doing in the trend following space because they didn't really have to. Everything was honky-dory, it was fine. And the small part they had allocated to equities, even if equities had a rough time, it didn't make a big difference. Well, last year it did make a big difference. Obviously, being Danish and keeping on an eye out for the Danish headlines, there were some pension funds in Denmark that lost significant amounts of their assets, which also makes me a little bit concerned because, I mean, yeah, of course, bond prices can correct and we can have a period of time. But, if the cycle has changed, interest rates might go higher for the next 2 or 3 decades yet. Of course, we don't know that. It's not a prediction, but I'm just saying I think a lot of things could be helped by structural diversification, as I think we both agree on. Anyways, the last 15 minutes of our conversation, Katy, I'd love to pick your brain about sort of global macro stuff, what's going on. I know you have been in the media a lot lately, talking about things that are not necessarily just trend following. So give us a taste of what you've been talking about, what you're finding interesting in the global market. And we're talking on a day where payrolls have come out, and so what better than to talk about economics and markets?
Yeah, I mean, this has been, to be honest, it's been a little bit of a difficult August because the first part of this month, I really felt like we started to see a flatter yield curve, right? The bond shorts were starting to work. We started to see the flattening, which I was hoping for, the steepening, which would say like soft landing, everything's going to be good. And it's been such a weird summer because we started off the summer with what our head of trading calls pause mania. So everyone was like, oh, it's a pause, everything's great, and then we stayed short. I mean, we've sort of seen short signals. I guess the biggest conundrum is bonds. I'm sorry to go back to bonds again. Bond signals from a trend following perspective have been short all year. And that particular signal hasn't necessarily, it got really in trouble in Q1 and it hasn't really worked much, but it has been correct to some degree over the summer. Because if you look at the yields for the 10-year, you can see that the 10-year yield has come back. And you can look at the 30-year, you can see that the whole curve has steepened. And it's flattened out a little bit. So in some sense, it's correct, but I'm not really sure where we're going. I think that's what the challenge for me. And then August came and the equity markets got spooked. Liquidity is always low in August, so who knows? People have been concerned about China, and equity markets been spooked about everything. And then we started to see correlation similar to what we saw last year. So we saw positive stock bond correlation. So stocks and bonds were selling off. The dollar started to rally and energy started to kind of rally and then puttered out a little bit with the China narrative. And so from a technical perspective, we started to look like last year. And of course, I got excited because that's like very similar to something that was working really well last year. Then the last week of August came around. And we started getting softer data. And so some softer data came in. I mean, as you know, this week we had the JOLTS data. We also had some private payrolls. We had sort of an on-par PCE number. So all these numbers came in and they were kind of soft, a little soft. And so then the market got exuberant again because like, yes, told you so. I mean, it was kind of like a told you so moment for the market. And that is not very fun for trend following because basically you talked about the returns this month. It's not a great environment because we started to see a good trend and then the market kind of reverted again. So you can tell it's not like it's kind of like a back and forth. We can't figure out, are we going into this direction or that direction? And so this last week has been a kind of a day of reckoning kind of moment. Are we going to go to this narrative of, Are we moving into the data is looking weaker and softer? So let me ask you a question. Good news is bad news. I hate that. I don't know about you. Like, everyone's excited. Yay, we have worse data in the labor market. I mean, I don't like that. I don't know about you, because like people don't understand if that keeps going, then that's bad. Do you know what I mean?
Yeah.
Or I don't know. How do you
Completely.
think about that, Neil?
No, I mean it's true. It is weird, and it did. I mean, I think the what's interesting about this to me is actually that the equity bond correlation in to a large extent, and of course what kind of tricked a lot of stuff up this year was really the the SVB event in March, right? I mean, it certainly to have taken the shine off some of the profits that would otherwise have been from being short fixed income, because actually, and this is what's interesting to me, is or maybe the US futures have not made new lows compared to October last year, but actually I think the German Bund did this month. So when I hear people say, "Oh yeah, we're bonds are going up," I'm looking at the data. I'm seeing I just don't see that. So there is a lot of emotions around this theme right now, for sure, in the narrative that we see. But as you and I know, price tells its own tale, and that's what we're going to be following. But it does feel like a little bit of a fight going on. I don't know if it's a transition just yet, because I actually think that there might still be higher yields to come before we get, because of course nothing goes in a straight line all the time. There will be a point in time where yields will have a period of time where they go lower, without a doubt. We just don't know when that is.
So, Niels, I agree with you. And that's why this week has been frustrating, because it's sort of like a head fake. Because my general view, and I liked how you put it, you kind of said, everyone says bonds are going up. And if you actually look at the price chart, take a look. No, they're not. And that's why our signal, the technical signals say short. And that's why I keep saying that. And I feel like I'm the only person saying that. And I got excited in August because some of the fundamental guys got up there and said, hey, we agree with them. And we've been alone this year saying that. And so what we've been saying too is, if you look at recent commentary from the Fed, they focused on their potential upside risk to inflation. And if you think about this, inflation is still coming in much above target. So the fact is, yes, we have cooler data. So that might mean no further hikes. It doesn't mean we're at target. And so if we're not at target, then we're just going to sit here in no man's land and wait until we get to the target. So it's kind of like you're coasting in with a boat, hoping that you kind of get to the right dock, right? And that, to me, what I think people underestimate, or at least feels to me that the market underestimates, is the amount of time that could take and how many missteps and potential ups and downs we might have on that trajectory that could cause rates to be higher for longer, which would mean that those long-term bonds are actually mispriced. And that's kind of what I've said, but I keep saying that, and then people just kind of go, what? So, I don't know. I mean, maybe that's the technical, because we look at the technicals, right? So we're looking at, what does the price tell us is happening? We're not saying, what do we think should happen? And the price keeps going down. So for now. And so I think that's a very interesting dichotomy, that the price is going down, but people keep saying it's going to go up. It's going up, right? What does that mean, Niels?
Yeah, there's a big disconnect about the narrative and what actually is happening. And we kind of started our conversation today talking about biases. And I think this shows, a very clear bias among investors in general, that they just, want things to go back to what they perceive as being normal, meaning lower rates. But actually, if we think back, 50 years, well, normal is probably closer to where we are now. Could even be a little bit higher rates that would be normal. And so it's all in front of us. Time will tell, so to speak. But it will be interesting. And the other thing is, I think generally speaking, after a strong year like last year, another narrative, of course, at the beginning of the year came out about, well, probably a lot of that profit will be given back by trend followers because it was such a good year last year. But actually, the industry is doing pretty well. I mean, yeah, we always will give back a little bit of what we made, and that seems to be happening. But we may be setting ourselves up for some new interesting trends. I mean, we've had to go through quite a big downward move in energies, and now things have turned around, and I would imagine a lot of exposure is now going to the upside. And so if this inflationary story comes back, and if a lot of that may be driven by, say, energies and other commodities, at least in some commodity markets, trend followers will be well positioned for that. But we'll see. The base effect is certainly coming out. I mean, there's not, I mean, or maybe it's, I don't know what the right narrative is, but we've taken out a lot of price drops now. And if energies and other stuff starts to go up from here, that's going to show up in inflation numbers. It's just the way it works.
Yeah, that's why when people have asked me, what are you watching? I'm like, well, let's watch where the cycle starts instead of where it ends, right? Like they're always looking at the end of the cycle. I'm like, let's look at oil prices or things that are going to, cause a new wave. I was actually very shocked watching oil prices in August because that to me was interesting. Like, oh, it started to move up. And I'm thinking, okay, if that starts moving up, that eventually pushes into things. So if we start to see something that is a problem in supply or some geopolitical issue or something, that has the ability to start a cycle of that, as opposed to thinking about the result of it. I mean, I think those are important, but most of the time, these things, I think that's why inflation is so interesting. At the beginning of this whole thing, I remember our head of trading saying to me, he goes, Katy, once inflation leaves the station, it's really hard to stop it. And it moves around in many places, and it's really hard to figure out where it's going. And I think that is really the truth, right? And so I think that's where we are right now. We're kind of in the aftermath of last year and trying to figure out, like, where are we now? And so I think this year, we're going to look back on this year and say it's all obvious now, but it was clearly not obvious at the beginning. If you took people's forecasts for this year, they're all going to be wrong.
Yeah, and actually, that's another great point you bring up there. I think that what the world benefited from was not in the last 20 years before, say 2020, thereabouts, was not only low inflation, it was predictable inflation. And I think what we've definitely come into this period is unpredictable inflation, meaning it can be low from time to time, and it can be really high from time to time. But it's going to, as you rightly say, it's going to change. And of course, the great thing about what we do is that our systems do adapt. They just don't adapt over a week or maybe over 3 weeks or 4 weeks. But I think that's the strength of it. And I always, when asked, I'm always fascinated by the fact that some of these strategies have been around for 40, 50 years, and how different the environments have been, how different the technology has been, and all the quote-unquote technological revolutions we've been through, like people talk about AI now as the next great thing, yet these quote-unquote more simpler strategies have just continued to adapt and thrive, really. So no doubt they'll continue to do so.
Well, Niels, I'd say people are people. And
well,
that's what these strategies work, because people are people, and human behavior persists throughout centuries, no matter how much AI or how much advances we get in technology. We have our biases and we take them with us. That's what I would say.
Exactly.
Yeah.
So we kind of end where we started, meaning with biases. Katy, is there anything else I forgot to bring up today, or do you think we've covered what we wanted to cover?
No, thank you, and thank you for the suggestions. I've got some good paper ideas, and I look forward to our next conversation.
We'll be reviewing them every time you put out a new paper. We'll talk about them on the upcoming episode. Anyways, the good news for everyone is, of course, that Katy will be back in a few weeks. In the meantime, if you love these episodes, head over to your preferred podcast player, leave a rating and review. It does help the podcast to grow. And of course, press follow so you can make sure you get any new episode that we release. Next week, I'm joined by Andrew Baer. So we're going to be tackling some questions about trend following again, but maybe from a different perspective. We'll see what's been going on in the replicator space and the ETF world, where today we saw the announcement of another big name CTA that has joined the ETF world. The name will be withheld by me until next week when I speak to Andrew. From Katy and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.